Peloton looked like a growth machine. Demand was huge, the brand was everywhere, and the company seemed built for the future. But what Peloton got wrong about growth was this: it scaled like the boom would last forever. And when reality changed, the cost structure didn't adjust fast enough. Peloton built its company on a powerful promise. It promised to bring the energy of a boutique fitness class directly into your home. For a time, that promise seemed unbreakable. The company's growth appeared unstoppable. It scaled operations at a breathtaking pace, fueled by a conviction that the world had permanently changed. Peloton acted as if the explosive pandemic demand was the new normal, a permanent shift in consumer behavior that would last forever. This was a bet on the future, that 2020 and 2021 were not an anomaly but a baseline. That single core assumption became the company's greatest strategic vulnerability. The central thesis: build capacity to meet what they believed was a new higher permanent level of demand. They invested heavily in manufacturing, logistics, inventory. They built factories. They bought shipping companies. They filled warehouses to the ceiling with bikes and treadmills. Every decision assumed demand would only go up. They weren't just satisfying customers, they were building infrastructure for a guaranteed future. The expansion was hailed as visionary, seizing the moment and building a durable moat around the business. But the strategy carried an enormous embedded risk. Treating a temporary surge as permanent created a rigid and expensive cost structure. The COVID-19 pandemic created a once-in-a-generation market opportunity for Peloton. Almost overnight, gyms and fitness studios around the world closed their doors. People were confined to their homes, searching for ways to stay active, searching for ways to stay connected, searching for ways to stay healthy. Peloton was perfectly positioned for this moment. High-end stationary bike, live classes, on-demand classes. It brought community and motivation of a group fitness class into the safety of the living room. From a luxury convenience to an essential service for its target customers, seemingly in an instant, this sudden shift in the environment triggered a massive surge in demand. Orders for Peloton bikes, Peloton treadmills skyrocketed. The company's revenue more than doubled in 2020 and continued to climb steeply into 2021. From the outside, and indeed from the inside, Peloton looked like one of the defining winners of the new stay-at-home economy. The company's stock price soared and its brand became a household name. This incredible success created a powerful feedback loop. The more bikes Peloton sold, the stronger its community became, and the more new customers it attracted. High demand reinforced the belief that the company had captured lightning in a bottle. Confidence within the company was at an all-time high. The leadership team saw the pandemic not as a temporary catalyst, but as an accelerant for a change that was already underway. They believed the world was permanently moving toward at-home fitness, and Peloton was leading the charge. This conviction was not unreasonable at the time. Every data point seemed to support it. Wait times stretched for months. Customer satisfaction was high. The narrative was powerful and easy to believe. Peloton was the future of fitness, and the pandemic had simply pulled that future forward. The key strategic error Peloton made was its interpretation of the demand signal. The company's leadership saw an unprecedented surge in orders and treated it like a new permanent baseline. They treated a temporary event-driven wave of demand as if it were a permanent rise in the sea level. This misinterpretation drove operational decisions and financial decisions that later proved disastrous. They built a company designed to operate forever at the peak of a boom, rather than one that could adapt when the boom subsided and conditions returned to normal. This mistake is common after sudden explosive growth. It is tempting to believe the good times will last forever, All the immediate evidence supports that view. Sales are climbing. Customers are enthusiastic. The press is celebrating your success. It takes significant discipline to question the nature of that demand. Is this growth sustainable? What happens when the unique conditions driving the surge disappear? Peloton, caught in its own momentum, did not sufficiently stress test that assumption. Instead, it doubled down, investing hundreds of millions, assuming pandemic-level demand was permanent. Imagine a small cafe selling 100 cups a day. A week-long festival comes to town and it sells 1,000 cups each day. He takes out a large loan, builds a massive cafe, hires 10 baristas. When the festival ends, sales drop back. He is stuck with oversized costs. This is what happened to Peloton on a much larger scale. The first signs that Peloton's growth was becoming a problem appeared not in its sales figures, but deep within its operations and financial statements. As the company rushed to scale, its cost structure began to stretch and weaken. The initial problem was an inventory shortage leading to long customer wait times. The company's aggressive solution was to dramatically increase production and purchase inventory. The pendulum swung too far. Warehouses began to fill up with unsold bikes, treadmills. Supply outpaced demand. At the same time, the company's logistics became strained and incredibly expensive. To shorten delivery times during the boom, Peloton acquired Precor for $420 million to gain US manufacturing capacity. It also invested heavily in building its own delivery network, even buying a shipping company to control the entire process from factory to customer. These were expensive long-term commitments. When demand was high, these investments seemed justified to improve the customer experience. But as demand softened, Peloton was left with a costly, underutilized logistics infrastructure that became a significant financial drain. These operational issues had a direct and damaging effect on profit margins. Storing unsold inventory is not free. It costs money for warehouse space, insurance, management. Expedited shipping, last-mile delivery are also very expensive. As sales growth slowed, these high costs, once spread across many units, were now applied to fewer sales. The cost to store, handle, deliver each bike went up. Unit economics began to shrink and eventually disappear. The company's overall cost structure became bloated. Peloton had hired thousands of new employees, signed long-term leases for showrooms and warehouses, committed to expensive manufacturing operations. These are fixed costs. They don't change much, whether sales are high or low. During the growth phase, they seemed manageable. But as revenue stalled, these fixed commitments remained and became a heavy burden. The company was now spending huge sums just to keep the lights on. Rising inventory, high logistics costs, a bloated fixed cost base began to burn through the company's cash at an alarming rate. One of the most critical concepts for any company that makes and sells physical products is the idea of inventory as trapped cash. When a business spends money to manufacture a product, that money is converted from cash in a bank account into a physical item sitting in a warehouse. The cash is effectively trapped inside that box. Materials, labor, shipping. But you cannot get that money back until a customer actually buys the product. Until the sale is made, the inventory represents capital that cannot be used to pay employees, fund marketing, invest in research and development. For Peloton, this became a monumental problem. It poured billions into bikes and treadmills. When demand fell, it was left with huge trapped cash sitting in warehouses around the world. At one point, billions of dollars worth on its books. This highlights the difference between profit and cash flow. Imagine you make widgets for 50 and sell them for 100. If you make 1,000, you spend 50,000. If you only sell 100, you bring in 10,000. Despite per unit profit, you are negative 40,000 in cash flow. To free trapped cash, Peloton had to discount heavily and keep paying storage, eroding margins and hurting its premium positioning. Every business has two basic types of costs, fixed and variable. Understanding the difference is essential to building a resilient company. Variable costs move with sales volume, raw materials, labor to assemble, shipping to deliver. You incur them when you sell. Fixed costs are the silent killers: rent for showrooms, corporate salaries, running factories like the Peloton Output Park, payments for owned logistics. The bill comes every month, whether you sell 1 million bikes or zero. High fixed cost structures create operational leverage on the way up, but become a heavy anchor on the way down. Peloton's strategic mistake was converting flexible, variable costs into massive, rigid, fixed costs, building factories and buying shipping companies, turning flexibility into maintenance. Heavy, fixed assets. It gave more control during the peak surge, but created enormous financial inflexibility when demand vanished. The company was trapped by its own commitments. A more flexible approach. Continue using contract manufacturers while piloting a small owned factory. Sign contingent contracts with logistics partners that scale up or down. Flexible operations act as a shock absorber. When demand falls, reduce variable costs quickly. A rigid, high fixed cost company cannot. Without flexibility, the company must carry the full weight of its structure, leading to massive losses and a desperate scramble to cut costs, layoffs, and restructuring. Peloton's rise and struggle is a lesson in operational strategy for fast-growing businesses. How can a founder or CEO avoid the trap that Peloton fell into? The key is to approach scaling with a healthy dose of skepticism, especially when growth is driven by an external event like the pandemic. Instead of assuming a demand surge is permanent, a smart operator tests its durability. Ask hard questions and design small-scale experiments to understand what drives behavior. Segment new customers. Are they your core demographic or a new type of user? Conduct surveys and interviews. What were you using before? What happens when other options return? This reveals organic demand likely to stick versus situational demand likely to fade. A smart operator would have noticed many buyers were temporarily replacing their gym membership. Run pilots before massive commitments. Add a line or two, use a contract manufacturer, increase output in a controlled way, verify profitable sell-through. Before buying logistics, partner regionally to test demand and delivery costs. Pilots provide real-world data with lower financial risk. Avoid huge upfront capex that locks you in. Build capacity in phases. Hire in cohorts, not thousands at once. Expand production in modular steps tied to sustained demand. Build a business that has options, not one locked into a single best-case future. As sales double and double again, pause and ask, what would happen to this business if demand were cut in half next year? This is not pessimism, it is responsible stewardship, a vital stress test to examine operational and financial resilience. Dive into unit economics and cost structure. If demand fell 50%, would per unit profits hold? Variable costs per unit may stay the same. Fixed costs per unit would double. Model it. How much monthly cash burn just to cover fixed costs? How many months of runway? If a 50% drop creates a cash crisis, fixed costs are too high relative to gross margins. Build flexibility, delay long leases, use third-party fulfillment. These choices feel less ambitious now, but create resilience when conditions change. Build for reality, not a dream. Ask yourself this: if demand slowed tomorrow, would your business adjust or get stuck carrying yesterday's assumptions? To put these ideas into practice, leaders need a dashboard of operational metrics that go beyond top-line revenue. Early warning for supply, demand, and cost structure. Inventory days. If it creeps up, production outpaces sales. Peloton could have slowed manufacturing long before warehouses overflowed. Track lead times and costs. Shorter is good unless costs spike via air freight or spiraling last mile. Sustainable ops balance speed and cost. Monitor storage cost per unit. Piling inventory eats margin. Watch variable cost ratio and contribution margin. Protect it fiercely. Discounts or rising inputs signal trouble. Pair with fixed cost burn. Rent, committed salaries, software. That is the whole gross profit must fill every month just to break even. Swap giant factory build-outs for pilot capacity with a contract manufacturer. Use staged hiring and temporary staff to handle surges. Negotiate contingent supplier contracts. Use 3PL fulfillment so logistics stays variable. Run conservative pricing stress tests. Model a 20% price cut to move inventory and its cash impact. These steps create an agile operation built to last. The dramatic story of Peloton's boom and bust offers an enduring lesson for every founder, operator, investor. The pursuit of growth cannot come at the expense of operational discipline and financial resilience. Scale for durability, not just for speed. Obsess over fundamentals. Guard profit margins as if they are the company's lifeblood, because they are. Scrutinize every fixed cost. Avoid converting variable to fixed too early. Use partners, contractors, and outsource solutions to maintain agility. Flexibility is strategic wisdom, the shock absorber that lets you navigate bumps without breaking.